Welcome to the latest episode of Damien's Market Update, the show where I talk about what's been going on in investment markets and what to look out for in the weeks ahead. Now, if you find this useful, make sure you hit that like button. Also, ask any questions below the video on YouTube and I will answer them. And also, don't forget to subscribe to the channel because I do these updates every month. Now, if you're watching this on YouTube, then I'll try not to wave my hands around as much as one of them is bandaged, but as you've probably noticed when I do these, I do wave my hands around a lot as I get excited. Now, cracking on with the show, if you recall, my last update back in September was called Goldilocks Return. Now, as September progressed, the initial optimism of investors who'd been banking on the Goldilocks narrative in the US began to wane. The hope that the economy in the US would gracefully sidestep both a recession and aggressive rate hikes was beginning to be put to the test. Now, strong data from the US services sector and the looming spectre of higher inflation began to sow doubts about the Federal Reserve's future ability to hold off increasing interest rates further. The situation wasn't helped by an IMF paper that was released during the period, which shed light on the historical persistence of inflation, especially after terms of trade shocks. Now, I'm not going to go into a full explanation here as I covered that in detail in episode 432 of the Money to the Masses podcast, and there is a link below this episode which you can click on and listen to that full explanation. But in short, the report emphasised that in many historical episodes, initial signs of declining inflation were misleading, often leading to premature policy easing. So that means things like cutting interest rates. Now, the insight from the past underscored the challenges central banks face today, suggesting that consistent and tight monetary policy is crucial and therefore likely in addressing high inflation, which is, of course, what we have now. Now, the current surge in the price of oil has also further complicated the landscape, especially given that one of the historic scenarios analysed by the IMF was that of the oil price shock in the late 1970s, which was followed by a second wave of inflation. Now, higher oil prices combined with a rallying US dollar, which surged to a new 2023 high, exerted additional pressure on stock markets, particularly in the US and emerging markets as we headed into October. However, the UK's FTSE 100 did find some respite, benefiting from the higher dollar and surging oil prices due to its exposure to oil stocks and companies with US dollar earnings, which are given a currency boost, which is always nice whenever the pound falls against the US dollar. Now, don't forget, that was pretty much the only stock market that made positive returns during September. In Europe, weak manufacturing data from Germany cast a shadow over European equities, and central bank chiefs from across the continent hinted at potential future rate hikes, adding to the prevailing market volatility. By September's end, bond markets also began to show significant shifts that further unsettled stock markets. The German bond yields reached their highest levels since 2011, with similar trends observed in French and Italian government bond markets. Now, the US wasn't immune either, with the 10-year US Treasury yield reaching levels reminiscent of 2007, a long time ago, with the yield heading towards 4.7%. This was further accentuated by a rare bear steepening of the yield curve, which is a phenomenon that often precedes an economic recession. Now, listen to podcast episode 433 for more info on that one. Now, in summary, investors ended September with less faith in that Goldilocks narrative, while becoming increasingly concerned that the only way central banks will end up taming a second wave of inflation is to keep interest rates higher for longer. Now, the worry is that this course of action could end up being what finally crashes domestic economies. So is it any wonder that pretty much everything you owned except cash lost money during September? I'm talking about bonds and equities in tandem, which is very unusual. The silver lining for UK investors during September was that the weaker pound, particularly against that US dollar, meant that their equity losses were at least tempered. Unfortunately, the start of October picked up where September left off, with global bond yields continuing their surge, causing further tremors in stock markets. The 10-year US Treasury yield pushed to new multi-year highs, while the 30-year Treasury yield hit a staggering 5%, which is the highest level since 2007. The German yield curve also saw significant movement, with the 10-year Bund yield reaching 3%. Now, this aggressive bond market sell-off in 2023, especially in longer dated bonds, is different to the bond market carnage of 2022, where the sell-off was more pronounced in the shorter dated bonds, which that happened because that reflected the immediate reaction to central bank rate hikes back then, whereas now the movements are reflecting the higher for longer fears that we've now got. So central banks might be forced to keep interest rates higher for longer to tame inflation. Stock markets already reeling from September's slump face further headwinds at the start of October. Even the FTSE 100, which had previously shown some resilience, began to falter. However, there were glimpses of stabilisation as bond yields retreated from their recent highs. But geopolitical concerns have now added another layer of complexity. The escalating situation in Israel and Gaza prompted an initial flight to safety, with investors flocking to US treasuries, driving down yields and bolstering the US dollar. Yet the flight was short-lived, and within days investors' focus had shifted back to inflation, especially after US inflation data for September exceeded expectations. Now, this unexpected data point reignited fears of further interest rate hikes by the Federal Reserve, especially given the backdrop of that strong data from the jobs market in the US. Equity markets typically react negatively to the outbreak of conflicts, but history has shown that such downturns are often followed by rebounds. Now, this pattern held true in the days after the initial attack on Israel, with both the FTSE 100 and the S&P 500 showing signs of recovery. European equities also experienced a boost, buoyed by rumours of potential Chinese economic stimulus measures. Now, don't forget that China is one of the biggest importer of European goods in the world, so obviously good news for the Chinese economy ends up being good news for European exporters, particularly in Germany. However, the uncertainty stemming from the Middle East persists. Now, this is evident if you look at the gold market. The price of gold rallied by over 3% on Friday, which reflects investors' apprehension ahead of another weekend of geopolitical unpredictability. So that rush to gold as a haven asset, we saw that throughout 2022, well, particularly after the initial invasion of the Ukraine by Russia, and that happened until investors' attentions moved elsewhere. So in conclusion, as we approach the middle point of October, investors have one eye on the situation in the Middle East, but the other eye is still firmly focused on economic data, bond yields, the US dollar, and the outlook for central bank policies around the globe. It's also worth mentioning that the Q3 earnings season is getting underway, which is also likely to attract investors' attention. Now, it's never easy being an investor, but seasonality might be about to offer a helping hand, and I'll talk more about that next time. So if you found that useful, please do hit that like button, but also subscribe to the channel, and also make sure any questions, put them below the video on YouTube.